What if the hand guiding your portfolio isn't human? For decades, the invisible hand of market forces shaped finance. Today, that hand is algorithmic. Algorithmic trading is no longer a niche tool. It is the foundational infrastructure of modern capital markets. Trillions in assets now move through systems that process data, predict volatility, and execute trades at speeds beyond human cognition. This isn't about faster clicks. It's about a fundamental shift in how markets function. The analysis is clear. Algorithms now absorb and react to global macroeconomic currents in real time, geopolitical shifts, central bank policies, even climate data streams. They transform fragmented market data into a continuous feedback loop, optimizing capital allocation across asset classes with unprecedented precision. The result? Markets that are more efficient, yet increasingly complex. For your portfolio, this means two things. First, the old models of risk and return are being recalibrated. Second, the opportunity lies not in resisting this wave, but in harnessing its intelligence. At Qanexra, we don't just navigate this new reality, we architect it. The future of finance isn't just automated. It's intelligent, and it begins now. The market no longer moves at the pace of human thought. It operates in the microsecond domain of high-frequency trading, where algorithms execute decisions before a single human neuron fires. This is not incremental progress. It is a silent revolution. Before the algorithmic age, trading was a human drama. Intuition honed by experience, the hustle and haggling of the trading floor, calculated risk weighed in the heat of the moment. Now, the market is governed by cold code, processing millions of data points and executing trades at unfathomable velocity. The human element has been displaced. The system no longer waits for judgment. It acts on prediction. This isn't merely a tool replacing a trader. It is a fundamental rewiring of the global market's macroeconomic fabric. The speed, scale, and opacity of this new reality mean the market functions at a level of complexity often beyond human comprehension. We are no longer observing markets. We are witnessing their transformation into a quantum ecosystem, where the invisible hand of algorithmic logic now directs the flow of capital across continents, in the blink of an eye. The revolution is silent, but its impact is absolute. The 2010 flash crash remains a stark lesson. $1 trillion vanished in minutes, not from human panic, but from algorithmic feedback loops colliding at machine speed. This wasn't an anomaly. It exposed a fundamental tension in modern markets. Algorithms engineered for efficiency, for executing trades in microseconds, can transform a minor dip into a cascading sell-off. A single order, amplified by competing systems, triggers a self-reinforcing cycle. Volatility isn't born of sentiment, it's generated by code. Critically, this isn't confined to headline events. Subtler, less dramatic flash events occur daily across global liquidity pools. A 0.1% price shift in a major index, amplified by high-frequency strategies, can ripple through derivatives, futures, and ETFs, eroding confidence without a single news headline. The cumulative effect is profound. Institutional investors recalibrate risk models, market makers tighten spreads, and the very notion of stable price discovery faces systemic strain. This isn't a bug, it's a feature of today's algorithmic architecture. The market structure we've built prioritizes speed over resilience, creating fragility beneath the surface. As we move toward quantum-scale trading, the challenge isn't merely avoiding the next crash, but redesigning systems where efficiency and stability are not opposing forces, but interdependent imperatives. The next phase demands that. Dark pools represent the hidden architecture of modern finance. These private exchanges, operating beyond public scrutiny, obscure true market demand. Trillions flow through them unseen, creating a fundamental opacity that distorts price discovery. Beyond the race for milliseconds, sophisticated AI algorithms deploy strategies like spoofing and layering. They place and rapidly cancel large orders to fabricate false supply or demand, manipulating prices for microscopic gains, fractions of a cent per share. This isn't about market impact. It's about exploiting fleeting, invisible arbitrage opportunities. The cumulative effect is profound. the market's underlying sentiment becomes nearly impossible to discern. Even seasoned human traders, armed with decades of experience, navigate a fog of artificial signals. The very fabric of market transparency is fraying as algorithms rewrite the rules in real time, unseen. This isn't a glitch, it's the new normal. Understanding this hidden layer isn't optional for institutional strategy. It's the foundation of navigating the quantum age of finance, where true insight demands seeing beyond the noise. The market no longer pits humans against price movements. It pits algorithms against algorithms, a relentless, escalating arms race for dominance. Firms now invest billions not in traditional research, but in nanosecond speed infrastructure and hyper-advanced predictive AI, creating a zero-sum battleground where only the fastest survive. This isn't just competition, it's a fundamental shift in market structure. The innovation is undeniable. Algorithms now anticipate volatility with unprecedented precision, optimizing liquidity and pricing. Yet this very intensity amplifies systemic risk. When interconnected trading systems react to identical signals at quantum speed, a single misstep can trigger cascading failures across global markets. The speed that fuels efficiency also fuels fragility. We are witnessing the birth of a new market reality, one where the race for computational supremacy is inseparable from the risk of systemic collapse. The question isn't whether AI will dominate trading. It's whether the market can sustain the speed at which it's evolving. The algorithms trade faster than regulators can react. High-frequency trading engines execute millions of orders per second, operating at speeds where human oversight is not just slow, it's obsolete. Regulators are playing catch-up in a race they cannot win with current tools. The core tension isn't just technological, it's existential. Can we harness AI's efficiency, its ability to optimize markets, reduce friction, and unlock capital, without allowing its profit-driven pursuit to inadvertently trigger systemic instability? The 2020 flash crash was a warning. The next crisis could be invisible, algorithmic, and global in seconds. The future of finance hinges not on slowing innovation, but on building regulatory frameworks that operate at the same quantum speed as the systems they govern. This demands real-time monitoring, adaptive rules, and international coordination, not just reactive fixes. The critical question isn't whether AI will transform finance, but whether we can engineer safeguards that prevent its power from becoming the very force that destabilizes the system it was meant to serve. The balance is precarious, but the cost of getting it wrong is measured in trillions. We must get it right. Our analysis confirms quantum algorithms are no longer theoretical, but the definitive edge in high-frequency trading. They resolve complex market microstructures traditional models cannot, delivering superior risk-adjusted returns through real-time optimization of portfolios across volatile regimes. This is not incremental improvement. It is a paradigm shift. The forecast is unequivocal. Within 3 to 5 years, quantum-driven strategies will dominate institutional alpha generation. Firms relying solely on classical systems will face structural disadvantage as liquidity concentrates around quantum-optimized execution. The cost of delay exceeds the cost of adoption. Quantum infrastructure is now accessible, not speculative. The action plan is singular. Allocate capital to quantum-ready infrastructure immediately. Prioritize pilot programs focused on portfolio rebalancing and volatility forecasting, areas where quantum advantage is already measurable. Build partnerships with quantum-as-a-service providers to de-risk integration. This is not about replacing human judgment. It is about augmenting it with computational power that deciphers the market's true signal. The verdict is clear. Quantum is the new standard. Those who act now secure the edge. Those who wait become obsolete. The quantum edge is no longer theoretical. It is the only sustainable path forward.